Welcome to this edition of Boost Live, where we focus on passive alternate investments, information, and education. So this is Philippe Schulligan, and along with Jeff Rodriguez, my co-host, we are co-founder of Boost Capital Group. Today, our guest will tell us about self-directed IRAs and solo 401ks. A few words about Boost Capital Group. It's a firm dedicated to helping busy professionals and parents want to preserve and boost their capital through passive real estate investments. We collectively have 10 years of experience, and we have invested in 2,400 apartments or $180 million portfolio. And we have produced today an average of 33% annual rate of return on full turn deals. Jeff, I'll let you introduce our guest.
Welcome to this edition of Boost Live, where we focus on the presentation in order to educate. And today we have our friend Brian Martinez with Nuview Trust. How are you, Brian?
I'm doing well. Thanks for having me.
Awesome. We're excited to have you. And Brian's going to drop some nuggets, break down some barriers, and pretty much cover how to implement your retirement account in alternative investments. And we're looking forward to it. So without further ado, Brian.
All right. Thanks for having me. So once again, my name is Brian Martinez. I'm with Nuview Trust Company. I've been in the self-directed IRA space for about 4 years now, and I love what I do. I get to educate people on different ways that they can diverse their retirement portfolio into what's called alternative assets. So I'm gonna cover some of the basics with you today. And of course, you can always reach out to me and we can discuss more one-on-one if you have questions. So what is a self-directed IRA? So a self-directed IRA is really the opportunity to diversify your portfolio into alternative assets. But what you're getting with that is a tax savings. You're going to be tax deferred or it's going to be tax free. It really depends on your strategy and which type of account that you want to work with. So you always want to discuss that with your attorney, your CPA, or your financial advisor. As you can see the disclaimer here, Nuview, we're the trust custodian. We are not financial advisors, CPAs. So don't come to our company and ask for those types of questions, because we're going to, direct you to speak to somebody that can give you that kind of advice. But what we can do is we can give you all the education you need and the tools that you need to understand how these retirement plans work for you. So Nuview custodies over $2 billion in client assets, and Nuview's been in business since 2003. So we've got a ton of investors that, are our clients. And not only that, we work with a lot of what we call referral sources. We have relationships with people that will refer us clients that want to learn more about self-directed IRAs. This is why I love being able to educate. So like I said, you can diversify your portfolio and you get to pick your own investments. That's the best part about self-directing an IRA. You don't really need an advisor to choose investments for you. You're investing in things that you already understand and like real estate. You're driving down the street, you see a commercial building, you see apartment complexes, mobile home parks, storage units. Those are some of the things you can invest in. A lot of people don't know that they can use retirement money to invest in these things. So there's different types of plans. You have your personal plans, your Roth IRA, and your traditional IRA, probably the most common. Then you have employer plans. So these are more common when you're self-employed or an entrepreneur. You have your solo 401k, your SEP IRA, simple IRA. And then you also have your specialty plans. A lot of people don't know that these plans can be self-directed or even invested. One's called a health savings account. If you have a high deductible health care plan, you'd be eligible to open a health savings account, and you can use the contributions that you make to that plan to invest in these alternative investments. And then you have your Coverdell education savings account. So if you're saving up for college tuition for the kids or the grandkids, that's another plan that can also be self-directed. So what can you invest in? These are some of the most common types of investments that clients will make. When it comes to real estate, that's probably number one. Most people enjoy investing in real estate because that is very competitive when it comes to the stock market. Would you rather put your money in the stock market where you really have no control over it, or in the real estate market where you can understand how that market works? So foreclosures, tax liens, apartments, real estate option contracts, condominiums, unimproved land, commercial property, whether it be, an Airbnb, a self-storage unit, a mobile home park, any of those things you can invest in using a self-directed IRA. There are some rules that I'm going to dive deeper into in a few. You can also do things like private lending. So there's secured notes and there's unsecured notes. You can be the bank and you can lend your IRA cash to maybe somebody doing a fix and flip, or maybe somebody that needs money for a mortgage. You can be that bank. And the cool thing about doing a secured note is if you're lending to that borrower and that borrower doesn't pay you back, just like a bank, you could foreclose on that property. So instead of your IRA owning that note at that point, now you own the property. So there's something that's secured by. Then you have private entities. This is where the syndications fall under this category, because you're investing into the actual company, whether it's an LLC or a C Corp, or however the deal's structured, you can invest in those using a self-directed IRA. So there's limited partnerships, you can do joint ventures, LLCs, even trusts. Any of those can be self-directed in your IRA. And then some of the other alternative space is cryptocurrency. So whether it's Bitcoin, Ethereum, Litecoin, those can also be held in your self-directed IRA. What are the benefits? Like I said, diversifying that portfolio, investing in things that you understand, things that you might already be investing in on your own right now, and you're getting that tax savings along with it. So I'm going to dive a little deeper into the personal plans and what the contributions look like. So your Roth IRA, you can contribute up to $6,000 a year. There's a $1,000 catch-up contribution if you're over the age of 50. And the thing with the Roth IRA that I like is that you're paying the taxes on those contributions you're making now, and it's going to keep growing for you tax exempt. When you're ready to take that money out as a distribution after the age 59 and a half years old, you can take it out tax-free. So that's the power of the Roth. Another thing about the Roth I like is that it does not have what's called required minimum distributions. So for traditional IRAs, SEP IRAs, simple IRAs, once you reach the age 72 years old, you're required to start taking required minimum distributions. But in the Roth IRA, you do not have that requirement. So you can keep your money building and working and growing for you until you decide you're ready to take that money out. And not only that, you can leave that tax-free vehicle for your beneficiaries. So the traditional IRA is probably the most common type of IRA most clients start out with. The reason why is because many people that have left employers, and most people have left an employer at one point in their life, they have these 401k plans. And that is usually pre-tax dollars. And if you ever leave that employer, you're allowed to take those funds and move them into an IRA. Now, it would be moved into a traditional IRA because it's also the same type of tax exempt. It's not tax exempt, I'm sorry. It is a tax deferred vehicle. So it grows tax deferred versus the Roth grows tax free. So the way the traditional IRA works is whatever you contribute to that plan is tax deductible, and then it grows tax deferred. So once you reach the age 59 and a half and you're ready to start taking any distributions from there, then you're going to pay the taxes on it. And it's based on whatever your tax bracket is at the time you take the distribution. So most people wait until they're actually retired, which the average retirement is about 65 years old right now. And now they're going to take it out. They're at their lowest tax bracket, and they're going to pay the taxes in their lowest tax bracket because that's what it's taxed at. If you take it out while you're still working, you might be in a little bit of a higher tax bracket depending on how much you're earning. So that's up to you if you want to take it out at that point and be able to pay the taxes on it. So that's the difference between the Roth and the traditional IRA. All right, so these are the employer plans. If you're listening and you're self-employed or you're an entrepreneur, then these are the plans you probably don't know about and you want to listen. The SEP IRA has higher contributions than a Roth or a traditional IRA. It's actually taxed very similar to the traditional IRA, but it's an employer plan. So you can contribute in 2021, $58,000. In 2022, it went up to $61,000. That's a nice chunk of change you can contribute to it. So this depends on how much you actually earn throughout the year. It's 25% of your earned income can be contributed to the SEP IRA. So if you make $100,000 in a calendar year, you can only contribute up to $25,000 to that SEP IRA, but that's a lot higher than a Roth or a traditional IRA. So it's something you might want to consider if you're eligible for it. If you do happen to have employees and you're contributing 25% of your salary to this SEP IRA, then you have to match 25% of your employee's salary to their SEP IRA as the employer. That's another thing you want to take in consideration. Then you have the solo 401k. This is one of my favorite plans by far. There's a lot of power in this plan. So number one, high contribution limits. $58,000 can be contributed to this, but it also has a catch-up contribution. If you're over the age of 50, there's an additional $6,500, but it went up in 2022. Now it's $61,000. plus the catch-up contribution of $6,500. That's a lot more money that you can put away. The way this works is you play two parts. You're the employee and you're the employer. As the employee, you can contribute up to $20,500. Remember, if you're over the age of 50, an additional $6,500. And then you can also do an employer match. The employer match up to 25% of your earned income. It just cannot exceed the contribution limit for that calendar year. But that's a lot of money you can put away. Now, the cool thing about this plan is if you're investing in things like real estate and there's any leverage, a mortgage, any type of borrowed money involved, well, normally you're taxed on that portion of your profit. So I'm going to give you an example. Say I bought a piece of real estate, and that real estate, I didn't have enough to buy. So I took a loan out. It's called a non-recourse loan of maybe $50,000. Well, that $50,000 that I'm making profit off of is going to be taxed at the UDFI rate. But if I did that same thing, so if I did that at an rate's tax, but if I do it in a solo 401k, it's not taxed. It's actually exempt from the UDFI tax. So this is why I really love the solo 401k, because a lot of clients that are self-employed prefer this plan over the SEP IRA. Only reason being is that they're exempt from that UDFI tax, so they can go buy real estate, take loans out. Same thing if you're investing in somebody else's deal that has leverage involved, for example, a syndication. You might want to consider a solo 401k because there's usually UDFI taxed. You're going to get a tax form called a 990T. So you are going to be paying a little bit of tax. It's not coming from the IRA. It's coming from that borrowed portion in that deal. So you can make a lot more profit if you're not paying that tax. And the only way to do that is in a solo 401k plan. Remember, always discuss this with your financial advisor before you do it. Not everyone's eligible for a solo 401k. The only way you're eligible for it is if you have no employees and you are self-employed, earning self-employed income, not passive income. It needs to be self-employed earned income. And then the simple IRA, this isn't as common, but it's more common in small businesses of maybe like 5 or 6 employees. Contribution limits are $14,000 for 2022 with an additional $3,000 catch-up contribution if you're over the age of 50. Now, if you have employees, there's a mandatory 3% match for every employee that's eligible. All right, so these are the specialty plans. You have your health savings account. This is a pretty cool plan as well. I'm gonna tell you why, because it's kind of similar to a traditional and a Roth IRA. Whatever you contribute to the health savings account is tax deductible going in. You can use it for medical expenses, or you can invest it, accumulate your receipts and invoices, pay those medical expenses out of pocket, keep that money working for you and invest it. And when you're ready to take that money out, it comes out tax-free as long as it's for medical expenses. Now, people think you have to take that money out at the end of the year every year, but you don't. You can accumulate those medical expenses as long as you want to. I've met a handful of people that have health savings accounts that are worth over $250,000. And it's because they maximize their contributions and they invested their health savings account into these alternative type of assets. And now they have a lot of money that they're able to use and take out tax-free, and they're just saving up those medical expenses for when they're ready to do that. So you can have either a family plan or yourself covered in this. You must have a high deductible healthcare plan to be eligible for a health savings account. So if it's a personal plan, it's only $3,650. If it's a family plan, $7,300 that you can contribute each year. Now, it doesn't sound like a lot of money, but you could partner this with your other IRAs into these investments. And now it might own a smaller percentage of the deal or the investment, but that's how you grow it. Then you have your Coverdell Education Savings Account. So this is for any parents or grandparents out there that want to be able to save for their children's college tuition. You can contribute $2,000 a year. Same thing. It's not a whole lot of money right now. You can contribute to it. It's not tax deductible, but it can be taken out tax-free for any education expenses. That includes tuition, uniforms, room and board, any of those expenses, but it comes out tax-free. So that's the power of that. You want to partner it with these. If you have multiple accounts, that's the best way to do it. So we talked about some of the investment choices that are the most common. So I'm going to just go through those real quick. I want to get back into the Roth. So we talked about how it's, one of the tax-free accounts. Talk to your financial advisor and see what they think if you're eligible for the Roth. Now, there is a limit. If you earn too much income, you cannot contribute to the Roth. So that's another thing. If yourself personally earn over $145,000 a year, you can't contribute directly to the Roth, but there's a way you can still open the Roth and make contributions to it. It's called a Roth conversion. So the Roth conversion is converting things like pre-tax dollars. So that's a traditional IRA, a SEP IRA, into post-tax dollars. And then it's called the backdoor Roth. You can Google it, learn a little bit about it, go to Nuview's website on our education resources page. We talk a lot about the Roth conversion and the backdoor Roth. And then we talked a little bit about the solo 401k and how powerful that is because you don't have that UDFI tax. The cool thing about the solo 401k is when you're making your contributions, they are pre-tax dollars, but there's this thing called a mega backdoor Roth. With a solo 401k, say you did maximize and you're able to maximize $67,500. It's a lot of money. And you don't want it, you want to pay the taxes on that now. You'd rather treat it like a Roth. You could do what's called an in-plan Roth conversion. So you pay the taxes on that $67,500. Now it's all Roth money. It's post-tax dollars, and it's going to grow tax exempt for the life of that plan. And then when you're ready to maybe close this 401k plan out, you can move it into a Roth IRA and take it out tax-free. So that's called a mega backdoor Roth. All right, so these are the rules. When you're making an investment with a self-directed IRA, there are some rules. It's got to be a passive investment. It must remain at arm's length. There's certain parties you cannot invest with. These parties are called disqualified parties. So that's the IRA owner. You can't invest in your own home. You can't invest in your spouse's deals, companies, or anything that your spouse owns. And you can't invest in your ascendants or descendants either. That is your parents and grandparents, children and grandchildren, and spouses of your children and grandchildren. So if they're the ones that are structuring the deal, if they are basically like high earners in the company, you can't invest in those deals. They've completely got to be, it's got to be passive. So it's got to be a third party. There's some family members that are not disqualified parties. That's brothers, sisters, aunts, uncles, cousins, nieces, nephews. Those people, okay, you can invest in their deals. It's still considered passive. You also cannot invest in anybody you list as a beneficiary's deals. So you got to treat it passive. If you did own a property and it required any rehab or work on the property, it's got to be hands off. You can't put any sweat equity in the property either. And say you did own that real estate and it has some expenses. Well, the IRA is responsible for those expenses, and all the income from that property is put right back into the IRA. So this is more if you like own a single family property or you have an Airbnb or something like that. But the flow of cash always goes through the IRA custodian. So that's where Nuview plays their part. And every year we need to know what the fair market value of your assets are worth. So these are the people that are just restricted, I mentioned. I'm not going to go through this whole chart, but like I said, your family members and anyone that owns a majority shares in a company, you don't want to invest in those deals. The process is really easy to get set up. So you want to set up your self-directed IRA first by filling out an application. Now, whether your money's coming from an IRA or it's coming from a contribution or it's coming from, say, a previous employer 401k, that's where you figure out if it's going to be a rollover, transfer, or a contribution. Contributions are easy. You can mail a check, send a wire, send ACH, and then it's just deposited directly in your IRA because the account's already been established. A transfer is only if it's from IRA to IRA. So if it's a traditional IRA, it needs to go straight to a traditional IRA. Same thing, a Roth goes to a Roth. And a rollover is if it's coming from an employer-sponsored plan like a 401k, a 403b, a TSP, any of those. Now, depending on how you made your contributions to it, if it's pre-tax dollars, that money is going to go to a traditional IRA. If there's any post-tax dollars in there, that money is going to go to the Roth IRA. So that's something that you want to call somebody on my team to talk about, and we can help you figure this out if you're unsure. Then you figure out exactly what investment you're going to make, whether that be a syndication or you want to buy a piece of real estate. Well, you let us know. And the actual investor is going to be Nuview Trust Company, custodian, FBO, and then your name and your account number. So now your IRA owns the shares or units or is on the deed of that property. And you want to submit all your purchase documents. So if you're investing in a syndication, you're going to get what's called subscription documents. You want to submit that to our transactions department. We have a private entities team. They're going to review those documents. They're going to send them to you to DocuSign where you need to sign. the custodian is going to sign on behalf of the IRA, and then we're going to send it back to whoever is structuring the deal, the company, maybe Boost Capital. We'll send it to them. We'll give them a copy of everything, give the client a copy of everything, and then we send the funds out, and now you've made your investment. And then once the property starts getting some cash flow coming in, your dividends are sent right back to the IRA, and that's how you build your wealth. All right, so these are what the fees look like. So because you're listening right now, this is a discounted fee schedule. This is called a sponsor-based fee schedule. This is only if you're investing into syndications. So it's $185 annually for the account. There's a $50 application fee, and then there's an asset holding fee of $50. So that's discounted from our normal real estate investors that just want to buy the one-off properties. Those are individual investors. This specific fee schedule is only if you're investing as a group into a deal that's raising capital. So if you're listening and you are investing into one of these deals, this is the fee schedule you will be getting. You just want to mention you heard about us from Boost Capital. So there is no more transaction fees. That is included in the $185. And if you have questions, you can email me directly at bmartinez@nuviewtrust.com. You can also follow our content. If you want to scan the QR code, we're on YouTube and Facebook, and you can go to our website, nuviewtrust.com. You can always email me or my team at IRAspecialists@nuviewtrust.com, and we can schedule a consultation with you. We do workshops every Wednesday at 1 p.m. We bring a lot of guest speakers in that can educate you on different types of opportunities and investments that you might want to consider. You have to do your own due diligence, though, before you make any investment.
Great information. Definitely imperative for busy professionals to have these tools. Definitely. So I have a couple questions, if that's all right.
Yeah.
Wanted to ask about the employer 401k. Is there a maximum or a minimum that can be rolled over into a self-directed IRA? Or can the whole account be rolled over?
Yeah, so you can only roll over pre-tax dollars, and you can move over, if it's a rollover, you can move as much money as you like, as long as it's pre-tax money. So if it's coming from a traditional IRA, a SEP IRA, a previous employer 401k plan, you can move the whole account.
Okay.
You mentioned syndications a few times. People can invest in funds as well, right?
Yeah, they can definitely invest in funds. That's pretty common. The cool thing about the funds is it's a group of investors. They're raising capital. So it's the same thing as a syndication, the way we treat it.
If there's for self-directed IRA, it doesn't matter if it's accredited or non-accredited investor. As long as it's not a Roth, an accredited investor cannot open a self-directed IRA. That's a Roth, correct?
So yeah, it doesn't matter if you're accredited or non-accredited to be able to self-direct your IRA. That doesn't matter. What does matter is depending on what the deal is, what the investment is. Sometimes the investment might have that restriction. If it's a 506c, well, usually that's limited to accredited investors. So they wouldn't be able to make that investment.
Okay. And can traditional accounts be converted to Roth accounts?
Oh yeah, you can do a Roth conversion anytime. Just be prepared that you're going to pay the taxes on whatever you do convert. So if it's a large traditional IRA, what I've seen some clients do is they'll just convert a little bit at a time until it's all in the Roth IRA. And even if the money's invested, they could convert. It's called an in-kind conversion. So it's the value, or say units, they can convert a little bit at a time. That way they're not paying all the taxes at once. So eventually it all becomes a Roth, and then they're happy because it's going to keep growing from there, tax exempt, and they can take it out tax-free later.
Okay, great. Well, we appreciate you coming on and explaining to us these key bits of information for our busy professionals. And we definitely look forward to having more calls and working with you.
Yeah. Thanks for having me again, guys. You ever want to put a group together, give me a shout, and we could do another class.
Okay, perfect.
Thank you, Brian, for this presentation. We just wanted to take a few minutes to tell you more about the Boost Capital Group Investor Club. So we understand that for busy professionals and parents like you, time is limited and investing requires expertise. That's why we offer passive real estate investments to preserve and boost your capital. Through our Boost Capital Group Investor Club, we'll take time to learn more about you, about your investing goals, and we will share valuable resources and opportunities to assist you towards achieving your goals. So please join us at boostmycapital.com/sign-up. If you wanted to know more about 5 ways to boost your capital, we have this guide that you can download on our website. We're looking at 5 ways to boost your capital. And for each of those investments, we're looking at the skills, time, safety, and tax benefits. Additionally, we're providing an analysis of 10 years of returns and volatility. You can find this guide as boostmycapital.com/guide. We also wanted to share about the Boost Wealth Fund. It's a one-stop shop to build your own customizable a la carte portfolio by investing in high-quality equity deals. So we're investing in core plus or value-add commercial real estate assets operated by experienced operators that are located in stabilized markets with upward growth potential. All properties will have over 100 units. Target returns is 15% internal rate of return, which is equivalent to doubling your money in 5 years, as well as an average annual cash on cash of 8%. Thank you. And if you have any question, please direct them to investor relations@boostmycapital.com. Thank you and see you soon.